More people are moving into the metals, pulling their price up, and now they're becoming monetary metals. And so I think this next market, this next bull market, is going to be much different.
Please join us for our next live stream Sunday, October 11th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, October 11th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you are new to this channel or you have not already done so, please do subscribe, hit the bell to be notified on new updates, and give us a thumbs up if you like what we do. We truly do appreciate your support. Steve St Angelo is our guest today, the author of the very popular and insightful SRSrocco Report. Steve considers studying the impact of energy on the global economy one of the most critical aspects that impact the prices of gold and silver. Steve also has a YouTube channel with the same name as his website, so please do visit and support his channel as well. It's time to saddle up and silver up for Steve St Angelo. Steve, welcome back to SBTV. How are you doing?
Great, Patrick. We've had some interesting things happen in the market. There's always a lot to talk about. Glad to be back.
Great. Glad you had time for us again. And yes, things have definitely changed since last time we spoke. So I'll start off with asking, what's going on with prices in the gold and silver market right now? I mean, prices have fallen off a cliff.
Well, it's interesting. And before I get into this, I want to say that there's two ways of looking at the metals. If you're a person who likes to purchase metals on an ongoing basis every month or on an ongoing basis, you don't really care about the price action. You know the fundamentals are important because over the mid to longer term, the price of gold and silver, the value is going to do very well. That's one person. And I respect that. But then there's the other person who gets up in the morning and puts on Hitco or puts on investing.com and looks at what's gold and silver doing this morning. Well, if you're going to do that, then you have to understand what's happening with these metals. And so when the metals go up the way they did, it's so funny. They can go up, up. But when they correct, they tend to correct very violently or very quickly. And it's not just the metals. I've spent some time looking at the day trading markets, and I see this all the time. It doesn't matter if it's a commodity, if it's a metal, if it's energy, if it's IBM, Tesla. Look at Tesla. I mean, Tesla lost $125 in its share price in a very short period of time. It could go up, but then it comes down. So I'm not too surprised. I did think we'd see a correction. I was surprised that it was that fast and that quick, though. So that did surprise me. But over the mid to long term, I do see much higher prices in the metals.
Technical analysis. What does technical analysis tell you about how low the prices of silver and gold can go in this correction?
The only way to understand that, and this has been an ongoing education for me, I learned that, first of all, like I said, if you don't care about the daily price movements or the everyday, then this doesn't matter to you. But people who say that technical analysis doesn't matter in a rig market, I used to believe that. I no longer do. Because even if there's manipulation, it's going to show up in the chart, right? Let's say a company is a bad company and it goes bankrupt, or it's been doing fraud like Nikola. Well, it eventually is going to show up in the chart, and the price is going to crash. Or if someone finds a really good gold discovery like never before, very high, then the price of the stock shoots up. Well, it shows it in the chart. And so I think the issue is, the only way to know where the price on a technical level, where gold and silver are going to go, you have to look at these very long dated quarterly charts. And so to get an idea of what silver and gold are going to do, I look at a quarterly chart. Now that's a daily chart is a day candlestick. A quarterly chart is 3 months. So when you look at that, you could see I go back all the way to 1970, and it shows a much clearer picture. And I write these articles I put out these videos explaining all this on the SRSrocco Report to the silver and gold members. And so I think what that's telling us is that I believe we're going to see, we still will see a correction lower in gold and silver before they start making their move higher next year. I don't think we haven't seen the lows yet in gold or silver.
You know, Steve, I watched your video titled Silver Price Heading to $30 or a Correction Lower several days after it was released. Now, back then, it was uncertain whether the silver price would break above or below the symmetrical triangle. And it's amazing how the price action now has performed exactly as your forecast, or as you forecasted in this video. Can you share with us about the relationship between the U.S. dollar index and the price of silver?
Yeah, now to say the reason why that call was correct wasn't because of what I said or my analysis. That's what the technicals were showing. And when you have a symmetrical triangle, and that's, it's interesting, the price of silver shot up in July, and then it shot up more in the beginning of August. It almost hit $30. But then over the next month and a half, it was forming in this symmetrical triangle. And even though on a daily close basis, it didn't go below it. Now, when you look at this symmetrical triangle, you'll see that it touched the lower part 6 times. It only touched the upper part twice, which means to me, the technicals, the traders were saying that it was going to go lower. And then once it broke below that symmetrical triangle lower line, and then it fell. And then it fell right down to the $23 level, which is this major Fibonacci level. And I said, after that, well, what's going to happen? It's likely going to bounce back up to 24.5. Why? Because 24.5 is the weekly support level, or its resistance level now. And so it's not that I have a crystal ball. It's just that I know the way the markets trade. And 2 days later, the price of silver went from 23 to a little bit more than 24.5. I think it was 24.53, closed at 24.48. Now, maybe it couldn't have done that, but when silver had corrected so much, it was due for a bounce. And where's it going to bounce? It's going to retest its last support level, and that was 24.5. And so now when you understand on a short-term basis, this is the way the markets trade, then it's no longer like it's no longer turning on Kitco and, well, why did the silver price just jump, $1.50 in the last 2 days? Well, that's because this is the way the markets work. So, and another thing is, what happened was the dollar hit a resistance level at the same time silver bottomed at 23, which I think the index, the dollar index, was 94.5. And that was a resistance level. And so after the dollar had rallied for several weeks, it was going to have a correction too. So when the dollar went down, silver went up. And it's as simple as that, Patrick.
Do you expect the short to medium term trend of the U.S. dollar index to continue to move lower, or will it strengthen?
Looking at the longer monthly chart of the dollar, and here's the thing. What happened with President Trump getting the COVID virus, testing positive? You see, all the technicals can show you is where these support and resistance levels are, and these different technical indicators. And so you have an idea, if it sells off, it's going to bounce off and go to a different direction. However, the fundamentals that are happening, or the things that are happening in the market, like the government coming out with the new stimulus package, that's going to push the dollar down, and the stock market up, and the precious metals up. So it's not that the technicals are going to do that. That's the market doing it. That's the government doing it. And so the technicals are reacting to it. But if I'm looking at the monthly chart, there's no coincidence that the dollar came down to the 92 index. And that is a moving average. And so, but after it came down, it's going to go back up and test the moving average it came from, and that's 96. So if the dollar is going to go up to 96, which I think it is, then the gold price is actually going to come down and the silver price. And my forecast is gold is going to retest 1800. That's the long 50-year chart, quarterly chart says to me that it's going to hit 1800 because it's done it in the past every time. And so for gold to hit a new high next year, I believe it's going to have to hit that 1800 level or even go lower, but it's definitely going to retrace and retest the 1800 level. So if the dollar is going to go up to 96, we're going to see a continued sell-off in the metals on a short-term basis.
Okay. How about silver? What do you think silver will be at that point?
Silver, now what's interesting, we could continue to see the metals move even higher because I don't think the dollar has corrected all the way down yet. It could move even lower. So we could see the silver and gold price move up even higher. We could see silver get to 25 plus, 25 and a half, and then it would have another correction. So it's going to kind of consolidate. And that's the way the markets work, right? You get a breakout. And I said this year, when silver broke above 1975, you're going to have a breakout. When silver broke above, I said, when it gets above the 24 and a half, which is the weekly level, it's been below that for like 6 years. When it breaks above that, it breaks out because you know what happens? There's a spotlight on the price. All the traders see it and they jump in. That's the way the market works. And everybody, all the precious metal investors get interested. They turn on the computer and they start watching too. That's the way the market works. So there's these breakout levels. And I think now if gold hits 1800, silver will go down to the 21 range. Could be a little bit lower, but it's got really good support at this 21, 22 range. Back in 1979 and 80, even though gold went to 875, on a quarterly basis, it did not close above 700. It stopped right there twice in the beginning of 1980, in the middle of 1980. And so for the next 30 years or so, it stayed below 700. When it broke above 700 in I think 2007, 6 or 7, it shot up to above 1,000. Guess what? It came back and retested 700 because that's the way the market works. Well, now the new number was 1,800 on a quarterly basis. On a quarterly basis, the gold price has never closed above 1,800 until this year. It went up to 2,100 just about. Well, guess what? It has to retest that 1,800. I'm not saying it's 100% guarantee, but if we look at the way the markets work, it's going to have to come back and retest that 1,800 level. So I believe there's a very good chance, if that's the way the markets work, we're going to see a retest of 1,800. Silver will probably go down to 21. And that means then that's going to set the prices up for the precious metals higher next year due to the fundamentals of an ongoing disintegration of the U.S. and global economy, with the governments coming in, doing more stimulus and propping up. That's only good for the metals. So that's why the fundamentals are going to push the price of gold and silver to even newer highs, I believe, next year.
Can you share with us about the significance that the U.S. saw record high silver bullion imports in June this year, just before silver prices took off into the 20s? What happened here?
Patrick, that was really interesting. And I did a article for the silver members now, because now I have a subscription service and I provide this information. It was interesting, and I'll tell your followers that silver imports, bullion, into the United States jumped from like 330 metric tons in May to 531. And it seemed to me that the entities, because the silver price really didn't go up much in June. It didn't get above that 1975 level. Matter of fact, for like 5-6 months, it stayed below that level. It just kept hitting it. It's amazing. It just wouldn't go above it. And so it seemed to me that the entities, hedge funds, and let's say investors, large investors, knew that the price was going to head up. And so there's a lot more bullion imports in June. But guess what? If you think 531 metric tons is a lot, you should have seen what happened in July. I've never seen that much silver come into the U.S. And I'm not going to give the number, but it was much. It basically it's half of the world's mine supply in a month. That's how much silver that was moved into the U.S. And I believe a lot of that silver was moved into the U.S. for the ETFs. I don't know how much, but a lot of silver moved in there. And so now what's happening? Now what's happening is you're getting record amounts of silver investment, physical silver, as in bars and coins, and you're getting record amount of silver moving into the silver ETFs. Now, we don't know if all that silver is actually there or if those bars are oversubscribed, but the amount of silver investment in the world that's forecasted for this year, it's double any year prior. That fundamental starts putting silver in the same category as rhodium back in the 2000s and palladium. And because palladium, the cost to produce palladium is under $1,000, but it's being sold now, it's priced at $2,300, and that's based on supply and demand. So now I think if we get another big year next year with silver and we get even more physical and ETF demand, we're going to see big prices because there's just not a lot of silver to go around. And so that's how I'm looking at the market setting up for next year.
Next year is when we can finally reach that $30 per ounce level and maybe say goodbye to sub 30?
Yes, I think when we look at the charts and you look at silver, the big number for silver is 35. That 35 is the big number. Even though 30 is a level, once it gets above 35, there's nothing until it goes up to the 40s, high 40s. So that's the level. 35 is the big number, is really the big number. And so when we get above 35, and it'll take time, I do believe in time, 35 will be the new support level for silver. And will it happen next year? I think there's a very high likely probability due to the fundamentals I'm talking about, not because I said so, not because the charts say so, but because I'm just looking at what these governments are going to do. And that's going to be very positive for the metals moving forward, especially when you see this kind of silver investment and only 1 or 2%, not even, only a very small fraction of people are getting into the silver ETFs. Can you imagine if Americans said, oh my God, I got to get into the silver ETF? They're not doing it. It's mostly larger traders that are getting into the silver ETF. Some people are. If you get a lot of people moving into the silver ETF, you get a lot of people buying silver, it's a whole different ballgame for the silver market. That's how I see it starting, especially in 2021.
Okay, 2021, very close. Steve, I looked back at the past silver bull markets like the one in the 70s and also the early 2000s. And if we measure from trough to peak, both bull markets are about roughly 10 years. The one in the 70s went from about 1970 and topped out in 1980. And the more recent one, 2001 to 2011. How many years more do we have left in this bull market in gold and silver?
That's a good question. I think, and before I answer it, there's the reason why we had the bull market in the 70s and the bull market in gold and silver in the 2000s. That was oil price inflation. And I've got charts showing that. Because in the 70s, in 1970, the price of oil was $1.80 a barrel. By 1980, it was $36. Well, let me tell you, if you're Homestake Mining, which is the largest gold miner in the United States at the time, and you're mining gold, the cost to produce gold went up significantly for Homestake Mining. And I've got the charts on that. So if it's going to cost a lot more to produce gold, well, the price has got to go up. The same thing with silver. So it was oil price inflation in the 70s that drove the metal prices higher. Then as the oil price came down, in the 80s and the 90s. That's when we saw that long 20-year kind of consolidation of the metals. And then in 1999, oil was trading at $14 a barrel. Well, by 2011, it was 100. Now it did hit 147 briefly in 2008, but that's not the average. I go by the annual average price. The annual average price in 2010 and 11 were 100, 105, 110. So because the oil price went from 14, that's about 7, 8 times, the silver price went up, the gold price went up. Why? Because it cost so much more to produce them. Barrick and Newmont, it cost them $370 to produce an ounce of gold in 2004. Now, it costs Barrick and Newmont $1,250, $1,300. So that's why the gold price is where it is. And that's why the gold price never fell below that 1,100 level, 1,150, 1,200 since 2013 to 2018, 19, because that's what it cost the mining industry to produce that metal. And the same thing with the silver price. So now I think going forward, we're good. This is a whole different market, Patrick. It's no longer going to be, I see it disconnecting from the cost. I don't think the oil price is going to continue to go up. It could see spikes, but I think it's going to trend lower. And there's a reason for that. And what's happening now, the gold and silver prices are going up when the oil price is going down. So there's a disconnect. What's happening? Due to all the debt, due to the problems with energy and everything, and the currency problems, more people are moving into the metals, pulling their price up, and now they're becoming monetary metals, not commodities. Because a commodity, you value it based upon what it costs to produce it and supply and demand. But when gold and silver are not just commodities, they're money. Because most of the gold that's ever been mined since the last 500 years is still with us. So it performs as money, a store of value. And now, as more investors are waking up and moving into the metals, it's going to pull the price up. And so I think this next market, this next bull market, is going to be much different. And I actually look at it as a bull market that won't end. Why? Because the energy situation is going to destroy the value of most stocks, bonds, and real estate. And that's not going to happen in a year or two. That's going to be an ongoing multi-decade, probably 5, 10, 15 years. And so the only way to protect your wealth as those assets are falling is in the metals. So to me, it's not where, okay, the price of gold is going to go to 3,500. I got to sell and get my dollars. What the heck are you going to do with your dollars? You only sell the metals in the future if you need to purchase something, not because, or you could sell gold for silver or silver for gold. But you're not going to sell because, oh, I got a high price and I'm going to go back into fiat currency. That would be very stupid because currencies are going to get into more trouble with the energy. So that's how I see this next bull market. It's a bull market that I don't think it's going to end. It's going to fluctuate, but I don't think the metals are just going to get stronger and stronger to own as Americans and citizens throughout the world understand the dire energy situation that we're facing. It just makes sense to own the metals in the future.
Okay, that's a good point. But Stephen, in both of these past bull markets, the price of silver topped out just under $50 in nominal terms, while gold went higher nominally. Do you expect silver price to surpass this $50 per ounce this time?
Yes, and I believe the reason why it'll be different this time is due to the fundamentals. People say, well, it took silver hit 50 in 1980, 79. It took another 30-something years for hit 50 again. So is it going to take another 30 years? No, because the energy situation in 1980 was much different than it was in 2011 and is much different now. You see people say, well, how did the U.S. get out of the Great Depression in the 1930s? World War II? No. It was the oil production. Because the U.S. was the Saudi Arabia in the 1930s and 40s. If it wasn't for the U.S. oil production, the Allies would have not won the war. So it was the oil production, the increase of oil production coming from Texas, Oklahoma, California. That was the leading driver of pulling the U.S. out of the Great Depression. Wasn't World War II, because if you don't have the oil, you can't do the manufacturing and build all the ships and all the tanks and all that. You have to have the energy to do that. Well, now we're peaking in this very expensive shale to produce oil. We're not going to have the energy to pull us out. And that's what people don't get. You have to have energy growth to pull you out of a recession depression. So this time around, silver is set up much differently, because when people start waking up to, it's like when COVID hit, everybody wanted toilet paper. Well, this time around, people are going to wake up, wait a second, things are starting to fall apart. I better get real assets. And so here is when silver surpasses 50, it's going to be due to these issues that we're starting to see right now. That's the reason why you've got so many people buying silver, ETF and physical. I only think that's going to get even stronger. And so when you start pulling all this demand in, it's going to behave like palladium. And even much worse, because let me tell you, I'm looking at the numbers. I'm starting to put the numbers together. At most, there's 5 to 6 billion ounces, maybe 7 billion ounces of silver investment in the world, plus or minus. There's 2.5 billion ounces of gold. That's about 2-3 times more silver, not much more. And a lot of that silver is held very tight. There's not a lot of good liquid silver. So when you see 3 to 1 and people want to get into the silver, there's just not much of it. And that's a fundamental that's going to play out over the next several years.
Now, Steve, I calculated the gains trough to peak for both bull markets, and the silver price gained about 3,100% in the 70s bull market and about 1,200% in the early 2000s bull market. Spectacular gains. If we conservatively apply a 1,000% gain to the silver price for the current bull market, silver would be well over $100 per ounce. My question is this a realistic expectation taking into consideration the current situation in the global economy?
That number right there, 3,100, looking at that number, that seems to me that's when the silver price was like $1 and it went to like $50. I tend to look at not the peaks, at the average annual price. To me, that's the longer, more that's the more sound number, not the peaks and the troughs. Is the average for the year that gives us the realistic picture. So I think if we look at the average increase, it was about 1,500%, and that's not that much more than the 1,200% increase, because the price of silver was like $5, right? And $5-6, and it went to 50. It was higher due to the cost to produce silver than it was when it was $1 back in 1970, or less than $1. Now, if we apply that same math, you're right. If you apply the same math and silver hit $11 this year, and you apply 100,000%, well, you're over $100. And I get that number. That makes sense to me. But to me, that number won't be based on the oil inflation, because oil drives the economy. It's not finance. Tell your followers, stop using energy for one day. Tell me how far you got. It doesn't matter how much money you got in the bank. If the bank doesn't have any electricity, you can't get your money. And so the energy is the driver. The oil is the main driver of the global economy. And so this time around, I think the increase won't be based on, as I mentioned before, the oil price inflation. It's going to be based upon investors moving into silver to protect their wealth. As the currencies and the debt and the money printing and the stimulus continue to get ramped up, as the energy starts to fall apart, and that just makes a bad situation worse. So, could silver get above 100? I think yes, it could, and that's due to the fundamentals. That's not due to the oil, the cost, which was the basis in the last 2 bull markets.
We touched on this just a bit, where we're looking at 2021 to see some pretty decent moves in precious metals. Which quarter of 2021 is likely for this to occur, and your reasons for that forecast for that particular quarter?
That's a good question. And unfortunately, I can't give you an answer because there's too many variables now. There's too many variables. To me, it seems as the setup would probably happen maybe in in the second quarter would be more likely a likely candidate for it to happen, because I think all the problems with the commercial real estate market, we're hearing that we see there's all this disintegration that's taking place in the real economy that's not really being accounted for. That's going to get much worse. So if we look at silver as an industrial metal, it's not good for silver as an industrial metal. See, I wrote an article yesterday, a public article said the former industrial metal, and silver shot up and copper and oil had fallen considerably yesterday. Now copper has turned around, but the thing is, I see now silver, the value of silver is going to be based mostly on investment demand. Even though there's still industrial demand, it's not going to be based on industrial demand. It's going to be investment demand. So I think as we have these issues start really taking place, it doesn't matter if industry slows down. It won't matter, because the bigger driver will be investment demand. And I see that moving up more, probably starting in the second quarter of next year. That's just a ballpark figure. Again, I look at the metals over several years. That's how I look at it. I'm just giving you a best guess as to where it would take place due to more stimulus, more money printing, more debt.
Okay. How about oil? Do you have a forecast for how oil will perform in 2021? Are we going to continue to see oversupply?
I think we are, because even though the market is saying the indicators, and I might be wrong about this, but even though the IEA and the EIA, these are the International Energy Agency and the U.S. Energy industry, even though they say that by the end of 2021, we're going to start getting back to the consumption that we had before the virus hit, I don't see that happening. I think there's too many things that are still disintegrating in the economy. And so what that means is, and shale oil is going to fall, because right now the shale oil drilling rig count in the United States is down 75% than it was a year ago. It was like 750 drilling rigs. Now it's down to 180, 185. Well, if you're not drilling, you're not producing more oil. And so we're going to see a decline in the production. But I think demand's going to fall too. So to me, even though we could see fluctuations in the oil price, I think the oil price is going to trend even lower. And so that's not good for the energy industry, because we had a bankruptcy yesterday. Oasis declared bankruptcy. And I think we're going to see even more bankruptcies of the industry. So I do believe the oil price is going to still remain low in 2021. And that's excellent news if the silver price and gold price go up for the gold and silver miners, because their cost to produce them is going to stay low. But the price they're getting is going to go up even higher.
These shale oil companies, you're saying a lot of them have gone out of business. Will they be able to come back anytime soon?
Even though the Fed and central banks can print money, they can't print oil barrels, and that's the problem. It comes down to that problem. And the world is using 4 barrels of oil for every barrel that they discover. So it doesn't take a brain surgeon to figure out at some point in time that's no longer good. The supply is going to fall. The interesting thing that we have to, and I subscribe to shaleprofile.com, run by N.O. Peters. It's excellent service. He has all the detailed information on over 100,000 shale oil wells. I could look at each individual shale well, tell you when it was drilled, when it was completed. I can tell you the lateral length, how much sand that was used to frack that well. And the problem is this: there's only so many drilling acreage out there. And you look at these shale companies, a lot of them, especially in the Bakken and Eagle Ford and the Niobrara, they have gone through 75 to 80% of their drilling acreage. So there again, you don't need to be a brain surgeon to figure out there's not much left. So we got a lot of that oil out. Now they can refrac, but I've seen the refracking. It's not good. They refrac, it costs a lot of money to refrac, and the production falls even faster. It declines even more. It's even more horrible. So to me, the shale industry it's like the gold mine, the 1980s, the 1800 California gold rush. It was a boom and a bust. And it didn't matter. After the boom happened, the gold production surged, and then they went through all the easy gold, and then they brought technology in, which these hydraulic water pumps that were blowing out the sides of mountains to get to the gold. Guess what? They never surpassed, with all that technology, the previous peak in the gold production during the California gold rush in the 1850s. So we're in the same predicament now with the shale industry. I believe that the top is in, and so as it starts to collapse due to the drilling rig count being so low, I think we're going to see even more problems with the shale industry. And it doesn't matter if the U.S. government bails them out, because there's just not much reserves remaining. It comes down to that. They could bail these companies out. You could privatize, you can nationalize the companies, but there's just not the oil left. And we've gone through it, most of it already in those fields. So that's the problem with the shale industry. It was nice while it lasted, and the party's over.
Situation between the U.S., Middle East, and Russian oil companies. Are certain groups controlling prices in an attempt to drive competitors out of business?
I think maybe initially they did, but unfortunately, because these countries now are very dependent on oil revenue, like Saudi Arabia, they need much higher oil prices to not only, it's not that the cost is high, it's that they use it to fund their government. Well, these countries at this price of in the 30s and $40, there's no way that they can really do much now. It's this oil price is gutting everybody. It's gutting the Saudis. It's gutting the UAE, Qatar. It's even hurting Russia, because these prices, there's no real profit there. And so I think the idea that they're competing, they're trying to manipulate the price lower to get rid of the competition, I don't think that no longer matters, because the energy return on investment of the oil continues to fall. And so there's not much profit there. And now with these prices, I don't see that as an issue. I really don't. So everybody's struggling at these prices. There's no real winners. I think it's going to be a lot more losers as we move forward.
When we look at the interconnectedness of the oil market and the precious metals market, how often does the price of oil put a floor on the price of silver and gold?
It does. It does put a floor, and it has, because we have to think this way. You always have to make things, connect the dots and make things simple. No company is going to produce something at a loss for an extended period of time and stay in business. I mean, maybe the government can, but they print money, but no commercial business that makes jeans or cars or pumps oil or produces gold or silver, they're not going to do it at a loss for a long period of time, or they're going to shut down. And so when you understand that, what's the number one factor that allows the profit to be there? It's the energy. And it's the minimum cost to produce. It's the cost to produce these things. And there's the margin. How much margin you're making. So to me, when the gold price and the silver price consolidated from the highs in 2013, 14, 15, 16, 17, 18, they stayed at where basically it cost to produce them. That's where they were. Silver gets a little bit more volatile. Silver can go below the cost of production. That's just the way it is because so much of it is produced as a byproduct. Only 30% is primary. So you could see primary miners suffer more than the gold miners because most of the gold comes from the primary gold miners. So the energy costs has been the floor in the precious metals mining, and that will continue. But I think now we're in a new phase. We're in a new transition where the cost will become less important. It's going to be demand. It's going to be demand. That's what it's going to drive it now.
Steve, we're soon going to see who the president of the U.S. is going to be. And I'm curious to know, how do you think this is going to affect the gold and silver prices? Or do you think this is just perhaps short-term noise?
I think it's going to be short-term noise because right now, due to the fundamentals of the energy situation, there's really nothing any of these candidates or the president can do. When the ancient Roman Empire collapsed due to the falling energy return on investment, it didn't matter if it was a good emperor or is a crappy one. Didn't matter. Maybe the short term did, but it still collapsed. And that was due to the falling energy return on investment of the Roman Empire. Well, the U.S. economy, the United States, is in the same predicament, as well as the rest of the world. China might be growing very quickly, but they don't get a pass. They don't get a jail-free card. The falling energy return on investment is going to impact China just like everybody else. No one gets out of this free. It's going to impact everybody. So to me, I pay less and less attention now to the politics because I realize the politicians can't print barrels of oil. And so I focus now on the fundamentals of the energy and what's happening with the energy, because when energy production falls, so does GDP growth.
Steve St Angelo, before we wrap up, can you let our listeners know more about the SRSrocco Report?
Well, thanks, Patrick, for your time. The SRSrocco Report recently, it became a subscription service. We still put out public articles, but we continue to put out, for silver members and gold members, detailed original work, news, what's happening. Like I put out the information about Mexico and Peru. I'm going to put out a new one shortly, how much production has come off, silver production from Mexico and Peru. And then the gold members that we have a service for is the same. They get all the silver member information and content, but I do advanced charting. And I also I'm focusing now on resource stocks. I'm starting to do analysis on the resource stocks. I did one on ethanol, an ethanol stock. The ethanol industry is a disaster. That's going to turn out to be a real boondoggle. We should have never done it. So I try to provide the investors and people insight to what's happening with the real economy, which is based on energy, not finance. And when you understand all that, everything else tends to fall in line. So I put out almost an article every day, sometimes two. And I will end with this. I did a gold member article on the top 6 gold miners using this long quarterly chart and this indicator, and it tells me that they're also going to correct because they've been doing that for 30 to 40 years. They get to a certain point and they're going to have to correct. Now, that doesn't mean they're not going to go higher, but they can't just keep going straight up. And so if you want to know what I look at the basis of where these are going to correct to, if someone wants to get into a mining industry or a mining stock, then you should know some of these indicators because it's beneficial to get a better price. So we provide that service. We still do some public articles. I do a YouTube video every week on Sunday, and we try to still put out public articles for the public use.
Okay, yeah, we're always having people ask us about miners, which company should they be taking a look at. So my answer will be to subscribe to Steve's services, and then you'll know what companies you should be looking at. Steve St Angelo, we thank you for your time, and we hope we can do this again, and we wish you all the best. That was Steve St Angelo of the SRSrocco Report. For more of his insights on precious metals and the global economy, please visit his website, www.SRSroccoreport.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content, and do also check out the SBTV podcast on iTunes and Spotify.